Okay, let me now bring on board Atul Suri to talk about what the charts are saying and how should one read into the global correction and yesterday's scary sell-off. Atul, good morning. Thank you for joining us. Is the party over? Do you think we've peaked out for the year, or this is just a routine correction?
Nikunj, for a market that's up almost 55 to 60%, 57% to be precise in 6 months, a 3 to 4% decline is not like the end of the party. We can even fall further. And I think it's very much par for the course simply because, as I said, that the percentage and the speed of gain that we've had, markets do correct. Right? They're not obliged to go up every single day, every single month. So we may have a correction. It started a few days ago. And mind you, this is global in nature. It's nothing to do with India. We can find reasons, here and there. But the fact is it's global in nature, and it happens because excesses happen. See, there has been a lot of retail money, a lot of, this Robinhood trade kind of play that is happening. And people are just chasing momentum and they've really moved down the quality ladder. So it is very customary for the market to correct at such points. We've given back, 3-4% from the top. I won't be surprised even if we correct another 3-4% and probably come down to something like 10,800 or thereabouts, where the 200-day DMA is. And this goes for not just India, it goes for global markets. Even if you look at the Dow, you'll realize that it is very likely that these markets can correct a few more percentage points. But what I feel is it will be good because a lot of froth has come in. A lot of novice players, a lot of people just sitting and, just playing whatever makes a 52-week high, buying it. I mean, life is not so simplistic. And a cleanup is necessary because momentary or temporary cleanups help in keeping the market healthy. If that doesn't happen, very often the bubble that becomes is very large and then it ends in a very nasty manner. So I personally am not so phased. I feel that at lower levels, it's a great opportunity to buy. IT and Pharma clearly stand out as massive trend reversals. And I feel it's an opportunity to buy around maybe 10,800 or so.
10,800, which means you feel that today or this week market may not bottom out, and in the short term 3 to 5% kind of a correction cannot be ruled out.
I think it is possible. I think it's possible because what really is worrying me globally is the way the dollar has spiked. See, one of the biggest reasons for this global move, and that is happening across asset classes, is the fact that the weakness of the dollar, which really is because of supply of the dollars into the system. What we saw yesterday and the day before yesterday was a certain kind of reversal. So if you look at the DXY, it's around 93.68 or something where it closed. I think if it goes above 94, it could lead to a little more cooling down in the risk on assets. And that is why you'll find that the hit in commodities is the highest. That's why you'll also find the hit in commodity stocks is the highest. So what may happen is that a little buoyancy in the dollar may lead to little cooling off. But this is not a trend reversal. I feel that this is a correction. And I think these corrections are good and healthy for the longer term trend of the market. And as I said earlier, that I would use this correction to increase my allocation towards IT and Pharma.
I thought you've answered the big question then, where you're increasing allocation. But let me put it differently then, given the kind of projections that are coming in, what is the kind of returns, average return, or you think that is reasonable to expect, let's say, in the next year or so?
Well, that's a question where all my presentations end with the client asking me that question. And that's a question that's can't answer. But the fact is, Abha, if you look at it, put things in perspective, that it's been 3 years since 2018. The index is where it is. Investors as a whole haven't really made a lot of money. Yeah, sometimes you had a move in banking, sometimes you had a move in IT, but you make some, you lose some. But there has been no substantial re-rating that has happened of the market. So you can almost say that the market has been in a range for the last 3 years or thereabouts. And very often when markets have such ranging patterns, We have good reasons. That's a different story. But whenever markets have such long-ranging patterns, when they come out of it, you have explosive moves. So I feel that the market in the next year or two, I don't know when, can't put my really finger to it, but is going to have an explosive index move. And as I said earlier, and I keep repeating it, that the sectorial leadership is changing. There has been a tectonic shift in the way, let's take IT for that matter. You're all talking about it this morning. But if you look at IT, post leadership in 2000, it's been 20 years really, barring for certain moments of, flight. IT really has not been the leadership sector. And in terms of weightage, it's probably second after banking. So the fact is that you are seeing, I see kind of multi-year or decadal change in trends that are happening, where banking, which led our markets for the last 10, 20 years, banking was, it just was the outperformer. And if you had private banks, the last decade really would have been fantastic. So I feel that this leadership is changing, and that is going to be very big. It's not a question of 3 months or 6 months, but the way IT is shaping up, the way pharma is, and this is not just India, mind you, this is global. We say banking is weakening out, but if you do a relative chart of bank Nifty versus Nifty, you'll find that as far as the ratio goes, we are at the lowest point as of today. The index has bounced 50, 60%, but the ratio or the relative outperformance, underperformance, banking is really struggling. And this is not just in India, this is global. If you look at European banks, they are a disaster. You had some issues with HSBC, etc. yesterday. So these are really a global trend that is happening. The leadership in banking is moving away from the standard brick and mortar banks towards the digital space. And one very big disruption is happening here. And that is, I feel, what is getting reflected. So I feel that the decade of leadership in banking is come to an end, and the baton is going to be picked up by technology, pharma, or some other players.
Okay, talking about leadership, there are, a handful of names on the index one can think of that have continued to move from strength to strength. So even if they may be looking expensive at this point of time, there could be a case to suggest that it merits being in some of those names, from a return point of view. Would you agree, Atul, that perhaps there isn't, pharma and IT aside, even another handful of names outside of the financials, whether it be an FMCG, whether it be, a Reliance, would you agree there's merit in that rather than trying to scout for new opportunities?
Yeah, that's very true. It's very true that opportunities coming up. Like you mentioned Reliance. You don't know where to classify Reliance. Is it an energy oil sector component, or probably the whole move that is happening is because of technology? So there is a bit of a very big representation of the technology play through Reliance also. So you're right that, whenever markets fall a lot, like we had during the COVID time, there always is a shift that happens. There are new realities. And these realities come about due to a few factors. First and foremost is technology, demographics, or government policy. And what we are really seeing is that the technology shift that has happened, this whole COVID thing is not going to leave us unaffected. I think that one clear sectorial winner globally is technology. And I think that is going to find representation in our markets, in the stocks that we have, and the kind of leadership that we will see going ahead. So I think that there are great opportunities, and most portfolios were underweight. Most of them will move to overweight. Most portfolios are overweight banking and finance. They may move to equal or lower weight. That shift itself is worth a lot of money. And that, I think, is going to be the big move that we are seeing. It's work in progress, and it is the starting of a multi-year trend from where we are right now.
Sure. Atul, I often ask our chartists whether there is any one stock or sector which has maximum correlation to the way the Nifty is going to move, where you track the stock and you know which way the market is headed next. Is there anything that you spot in particular?
See, I'm not a chartist in that sense of the term. I do look at charts, but I do combine them with fundamentals. And Aisha, what really is very, very visible is obviously because of the general state of the economy. coupled with the fact the kind of numbers that are coming out, I feel that the kind of companies that are still managing to buck the trend, and we will see that in the next quarterly numbers that come, will be a handful. And these are going to disproportionately reward investors. So, one can mention about Reliance as being a very good proxy. Like in the US, to look at the NASDAQ, people use Apple as a proxy. For many years, I guess people were looking at the bank Nifty as a proxy to the Nifty. But I feel that at the moment, I think technology, Reliance, these are all kind of plays that I feel will give leadership to the market, and they will give us a lead sense into the direction of the market. I must disclose that I have a vested interest. I have Reliance in my portfolio. I'm overweight technology. So whatever I may be saying is biased. So please do your own research.
Sure. So if there's one stock, Atul, that you had to recommend to our viewers on how to get rich, which one would you pick out?
I don't know. Nobody knows. Let me tell you that. I mean, that's a question which we all wish we had. There's a beautiful line, they think we know, but we know we don't know. So the fact is that, let's not be so sure about these things. Markets are a game of probability. If anyone says that, I know that stock that's going to make you rich, believe you me, he's lying, or he's dumb. The fact is that after having spent so many years in the market, this is a game of probabilities. You have a few bets, you be overweight, underweight somewhere, and you ride the trend. That is what I have really learned on. There is no one silver bullet or golden bullet. There is. You just have to keep your risk under control. People think creating wealth is all about picking that one stock or some tip. But, it has so many more components. Yes, picking stocks is one bit, but what percentage, how do you allocate? You can be wrong, and you're going to be wrong half the time in this market. Where do you exit? So I think managing a portfolio or creating wealth is a sum total of all these. When you study the biggest investors or the most successful investors, you really get shocked at how the 80-20 principle works. That 80% of the wealth is only created by 20% of the stocks. And it's this ability which really, I think, differentiates, or if there's one such stock idea, or if there's one such strategy, it is this whole 80-20 principle. And repeatedly, you hear George Soros talk about it, all great investors. Even the great Warren Buffett, the biggest wealth creator. Ultimately, you will find that it's concentrated portfolios. In his 90s, maximum wealth he creates in a stock is Apple. Just imagine what this market teaches us. So sorry to not give you a direct answer, but give you a bit of gyan. But that's the way I think. I think it's all about managing risk and riding the trend.
I'll ask you a direct question. Which are the three stocks you are holding, and when do you think the 20% period of the three stocks will come?
I think that among my holdings, my largest allocation is, again, as I said, I may have a vested interest, is Divi's Lab. It's something which is my largest holding. Reliance is my second largest holding. As I said, that I really classify the price movement or the upsurge in Reliance more linked to technology than the old petrochem business. And the third stock that I have in my portfolio, which again is a technology-related stock, is Naukri or Info Edge. Again, something which is technology-facing and a beneficiary of the internet and digitization that there is. So essentially, there's an overweight bias towards pharma and IT, and underweight towards banks and financials. 6 months ago, it was very different. Banks and financials dominated the portfolio. But this whole fall in the COVID space and the kind of behaviors that you're seeing and the kind of scenarios that are emerging are making me more and more convinced that the pendulum, and I'm saying it's a decadal pendulum that is shifting away from banking and finance towards technology and healthcare.
Look at the mid-cap space today, just getting clobbered, seriously. Mid-cap pharma, mid-cap chemicals, mid-cap specialty chemicals, just getting clobbered across the board now. Natco Pharma is down, Jubilant is down, Newland is down, Alkyl Amines is down. Metals also are really, correcting. You've got Indian Hotels, which is down. Atul, a lot of these so-called hope trades, whether it was hotels or airlines or perhaps, futuristic businesses or markets which bought into recovery or balance sheet repair, they've come down, whether it is Tata Motors, Z, even, something like Indigo. What do you make of this trade?
There was a hope trade. See, it ultimately all has to translate into numbers, Nikunj. The fact is that, yes, we will find a vaccine and yes, the world will restart. But the fact is that there are a lot more twists in this game. This whole industry, which is airlines, travel, is getting clobbered globally because suddenly they feel that there's a second wave coming down and there are fears of shutdown. And these games are going to go. It's like a typical Hindi movie. The script is there. Okay, you'll have a happy ending, that you will have a kind of a vaccine or whatever. When it comes, who knows? But the fact is that in that there are going to be a lot of twists and turns. And these hope trades are good if one is you have that immense time horizon and that immense risk-taking ability, which most people do not. Most people, as I said, were the Robin Hood gang, which was actually trying to play because X bought, Y bought, because you saw that sort of momentum. I think that wealth will be created in these if you buy them in absolute distress and you have that kind of time frame. And when they will move, they will ultimately move when they show the numbers, when they show the performance. And one doesn't know what the outcome of this world is. So I would rather play certainty. I would rather play companies which are delivering even in difficult times and where there is clarity. When we restart, what will happen, where there will be demand destruction, what sectors will move. Yes, you could be lucky, you could be great and pick some crazy multi-baggers at distressed valuations, which is available right now, but you're also likely to be very, very wrong. So rather than visualize a post-COVID scenario, I would rather look at this as a work in progress and bet on what is there in the now and where companies are able to even deliver in difficult times. So I think that's something and that suits my style, because I'm not a crazy risk taker. I'm not one is 200 kind of player. For me, I need consistent compounding stocks. I need stocks that do well even in difficult times, where the drawdowns are low. And that suits my style, or that's my thought process, really.
Atul, well, many companies during this time have managed, to see a rationalization in terms of their cost structures, efficiencies, and therefore managed to deliver on that account. Has there been anything, even if you've not necessarily looked at investing in outside of the basket that you're more bullish on, but is there anything that surprised you in that context?
I think what has been very impressive, of course, is a sector which just Nikunj mentioned is getting clobbered, is specialty chemicals. I mean, this is a sector, again, as I said, that it was doing well even before in the pre-COVID world. And even now in the COVID space, that this sectors and stocks did well. Of course, there's a bit of momentum and fraud to it, so they will correct in the short term. But I find that government policy has been a very big trigger. And this is, again, a trend that has been playing out and continues to play ahead. You are seeing companies execute very well, excellent efficiency, and even in difficult times, deliver good numbers. So for me, the third sector that I find, which is more a function of execution and opportunity due to government policy, is specialty chemicals. As I said, that, these things are frothy in the short term, and you will get better buying prices. But I would think that these are larger trends at play, and I would use the dip at certain point to actually get into them.
Specialty chemical play. We're also entering that time of year where, at least globally, Atul, there's going to be a lot of volatility. Seasonally, September, October, they tend to see a bit of settling in. We're also heading into elections and continued uncertainty, of course, around the coronavirus news and so forth. So in light of that, in the very near term, would you also suggest a little bit of caution to investors, or do you feel we're still going to be relatively isolated?
No, I feel that we have a very big event in the US elections, and anything can happen. Both the sides, it can swing both ways. And both the candidates have a very different view towards equities, stock market, and things like that. So there can be a big shift. There can be a very big knee-jerk reaction if A wins and not B, or vice versa. Also, it seems that the way the kind of noises that you're getting is it may not be very clean. It can be messy. It can go to courts and things like that. So I feel that can be a period of uncertainty. Early November can be a period of uncertainty. Another factor which could affect India is the India-China border issue. It's not really covering headlines. Unfortunately, some Bollywood is grabbing headlines, but I think that is really serious because till now we've always had issues with Pakistan, and it's always ended quietly because there has been a certain mismatch, a strength differential. But in the case of China, India is encountering a very different animal. Chinese are by nature very, very aggressive. And if you can see it even in the way they're dealing with the US, and India is a very small part of that. So that kind of aggression is visible. The border isn't cooling off. You never know, some things can happen. Again, I'm not talking about a war or something like that, but, casualties, flashpoints, these also are things that can lead to volatility. Apart from the US elections, I also am keeping an eye out for this whole India-China border issue because things are not cooling off. It's not. In fact, the build-up is just increasing day by day. And that's not good news because even a small mistake can result in some sort of problems. That can take a hit on our market. So I think these two issues are, more compelling. I think they are the things I would look out for. But the sad part is it's difficult to know the outcome. When they come, they will happen. And then it's just about being in quality, controlling risk, and being sensible about what you do.
Fair enough. Atul, coming back to what you were saying, about the financials. And I think there's a bigger question here as well. The calls for the government to step up spending, whether it be an ongoing debate in terms of the ramifications, only continue to grow louder. The projections for the recovery seem to be extending further and further in terms of really being back substantially, perhaps, or starting to be factored in to those quarterly financials. So, in that context, do you really see potential for a comprehensive move without the financials really participating? Can we simply sit back and say, yes, the dynamics are changing, and the flavor of the market is changing and leave it at that? Because they're really too big a pocket to ignore.
I agree with you that they're a very big part of the economy and you cannot have a recovery without banks and financials. But a recovery in bank and financials at the business level is okay. The question that I have to ask myself is that as an investor, will I make money in the market? I'll give you an example. The last 10 years, telecom has been a sector where a lot has happened. The usage, the billing, it's been a boom in that space. But as far as the listed space goes, investors have not made money. Bharti at best has been flat over 10 years. Vodafone, Idea, and many other small stocks have just vanished. So the fact is that there is no getting away from the fact that banking is the most important sector. It's an integral sector. It will revive. It will have to be revived. But the fact is that is what may happen at the ground. The issue is about stocks and investing. And I feel that the trend change that has happened, the leadership that has happened, the baton is moving towards somewhere else. So one cannot take away the importance of banking from the economy, but it is a very different thing as an investor. I ask myself, that will I get the leadership? Will I get the outsized returns? Will I be able to create alpha? Will I create differentiated returns in banking as a sector? You will have times, you will have pockets. Yes, there will be phases, but what I'm talking about is a 10-year kind of leadership or a 20-year kind of leadership. If you go down and plot the bank Nifty versus the Nifty from the year 2000, that's 20 years, you'll find that the bank Nifty has just outperformed relative to the Nifty itself. So what you have is a case of a 20-year outperformance in a sector. The thing is that even if this comes back to mean, that would result in a lot of underperformance in the banking space. And that is all I'm saying. I'm not saying that the sector itself will go through crisis. It is central. It's the heart. We all know it. But as
Trevor, really appreciate your time. Got to leave it there. Let me now bring on board